that me?
That's not me.
It's making a noise. Sorry, I'll start again. Someone at your door. Oh, it's my FedEx delivery.
Yes.
So Phil, how are you?
I'm very well, thank you.
Thanks so much for coming in. I've got a load of questions here, which
Okay.
I want to talk about, but
Excellent.
I'm sure it'll just go off on some random direction. But there's some things I think people really want to know the answers to, or there's a lot of confusion, and there's a load of stuff. If we can have time, I'd like to get onto because it's things I'm sort of personally interested in. So, what sort of size companies do you normally deal with?
So we deal with a whole range of companies. They've right from a startup business just starting out on their business journey, right up to turnovers of up to £200 million. So quite a range of businesses, quite a range of challenges across that client base.
And when somebody starts a business for the first time, what are the things that they should get in place to make sure that they don't make mistakes later on?
Well, I think getting the structure is important, and we'll come on to the various structures throughout this chat. Just the basics: bank accounts, keeping your business separate from your personal accounts, for instance. Insurances, you need to think about these things. Business plan is always good. It shows you which direction your business is going in, what your goals are, and it can help keep you on track.
When should you get an accountant?
We often find it's probably better sooner rather than later. It's something that's quite easy to put off, but with the right guidance, it helps you build those foundations and answer those questions earlier on.
I think most people have heard of the different types of ways that a company can start. So you can be a sole trader, you can be a partnership, you can be a limited company. So how do those fit to the various types of business and the ways that people should start? And how is that all relevant, and what is best for the different scenarios?
Well, I think what's best is down to sort of your personal circumstances. A sole trader is, it's the simplest form of business. It's an individual starting out, has an idea and wants to start trading with that idea, generating an income from it. It might be a passive income on the sideline, or it might be an idea that you're not sure how it's going to go. So it's a good starting point to test the waters.
So if somebody's starting, let's say a typical example, say somebody's got a gardening business and they've just started by themselves for whatever reason, what route do you suggest they would go down?
Well, as a sole trader, as I say, that's a good starting point. But with something like gardening, there could be risks involved, which is where you might look at a limited company instead. Limited company has limited liability. That's the limited in the name, as opposed to sole trader, which doesn't have a limited liability. It's your exposure is unlimited to, essentially your house is on the line if things go wrong and if a claim is made. Whereas,
So what are the different liabilities financially and what are the requirements in terms of banking? Do you need separate bank accounts for both, or can you run it through your personal bank account?
Yes, so you should have a dedicated bank account for either. As a sole trader, it will be in your personal name because there's no separate entity. So it would be a personal account, but it would be a business account. It might be denoted as trading as, whatever your business name is. With a limited company, it's a separate entity which has its own legal personality. So that needs a separate bank account in its own right.
And in terms of the limited company is sort of more of I think of it as more of a legal entity, and there are I've got a limited company, so I know there's certain things I have to do. But looking at the difference between sole trader, partnership, and limited company, what is the onus on the individual or one or two people that are starting in terms of what they have to do?
So a sole trader and a partnership, they're not registered anywhere. They're governed by, a partnership is governed by a partnership agreement. A sole trader, you make your own decisions. So regulatory, and in terms of having to register anywhere, there's a lot less involved. You have to register as self-employed, you have to register to do tax returns, for instance, and register for national insurance. But other than that, there's very limited amount in terms of registration or regulatory requirements. limited company, on the other hand, is registered at Companies House. The constitution of the company is a publicly available document. The shareholders and the underlying people behind it are all sort of named at Companies House. So there's that extra layer of regulation for limited companies.
And if you're going down the limited company route, I know it used to be you had to have a minimum of one director and one secretary. Is that still the case?
There's no longer a need for a secretary, but you do need a director.
Okay. So it can just be one person as that director?
Yes.
Okay. And then something you touched on earlier, which is if you started as a sole trader or a partnership, let's say you've got a roofing company, for example, and you destroy somebody's roof or something collapses or all the tiles fall off and smash into their car, and, you know, the amount of money that's involved is significant and you're going to be sued or something like that. How does that work exactly between a sole trader partnership and a limited company?
Okay, so again, we touched on things you need to do as a sole trader. So insurance is one of them. So hopefully that would cover you in any event such as that. However, if the insurance was insufficient or you'd not got round to setting it up or hadn't renewed your premium, as a sole trader or a partnership, it's not a separate legal entity, it is the individuals involved, and therefore the liability falls to them personally. So any liability is a personal liability. If it's in a limited company, it's the shareholders who own the company, and their exposure is limited to the share capital they've subscribed for. So it puts a layer of protection in.
So I might be confused here, but you've got the sole trader and you've got the partnership.
Yeah.
There must be some fine differences between those two because they sound sort of the same to me.
They are broadly the same in that they're taxed the same way. It's an individual entity. The partnership has its own tax return, for instance, but ultimately, a partnership is two sole traders who've joined forces. Is a simple way to look at it.
Okay, so that was going to come to my next question. If you've got two people that want to start a company together because they've worked somewhere before and they've decided they can make a go of it by themselves, they should be looking at maybe let's say it's a trade type business, for example, or it could be anything, it could be a software business. Should they start off starting off as a partnership, do you think? Or does it depend?
It depends. A partnership is, as I say, a good way into it if the regulation is lower, and it's a good way to test the business is viable. If you're certain it is, you might want to go straight into a limited company. There's nothing to stop you doing that. Perfectly within your rights to do so.
There is, I know from my experiences, having a limited company that's VAT registered gives a different impression of your company to somebody who's just a sole trader in certain areas for certain types of work.
Okay, well, that's interesting because VAT is it applies equally to sole traders and partnerships. If you breach your threshold, you are required to be registered for VAT in the same way a limited company is.
What's that threshold these days?
It's around 90,000.
It's quite a lot.
It is quite a lot.
That's turnover, presumably.
That's turnover. So
Okay.
it's quite a size, especially for a startup.
Yeah.
But the interesting point that you raise is it gives a different impression for a VAT registered business, and that is one of size and substance. So you can register voluntarily, and you might have a turnover of, let's say, 20,000. You're not required to, but you choose to. So you could do that, and it would give the impression that you are larger than you actually are.
I think it's sort of like looks more established. I don't think necessarily it gives him, because anybody can be a limited company and VAT registered, but for me, I think it just looks like you are a proper legal entity. You look more established. It's only an impression because it could be a 20,000 employee company, but it could be one man on his own, for example, or one woman on their own.
Yeah, exactly. It is all about that, how it's presented to the outside world.
Are there any downsides to registering for VAT voluntarily before you reach that 90,000 threshold?
You have to keep the 90,000 under review in any event. It's quite easy to miss. It's looked at on a rolling 12-month basis, so it's not a case that you get to the end of the year and decide. You've got to constantly monitor it. So if you're there or thereabouts and you think you may be breaching it in any given month, to be on the safe side, it might be worth registering in any event. So missing the deadline is the downside of not registering.
So if you're way below that threshold, let's say 25,000 as a rolling, average or however it's calculated, and somebody wants to be VAT registered, what are the downsides?
Well, the downside is it's another layer of administration that you have to submit quarterly VAT returns. So you've got another layer as well as your annual accounts. You've got to report your VAT quarterly to HMRC. If your turnover was, for instance, over 50,000 for sole traders, we've now got Making Tax Digital, which is a different topic altogether. That's recently come in, which means you've got to do quarterly returns anyway. So if you're over 50,000, there's probably very little downside on a reporting front. However, it does mean you have to add 20% onto your sales price. So if you've got a customer who's not that registered, you've just put their prices up by 20%. So you're either no longer competitive, or you have to cut your prices to maintain your customer base.
So it's like, if you decide to do that, then you either add 20% or you reduce your prices by 20% and absorb that.
Exactly.
For the privilege of being VAT registered.
Yeah, that's exactly it.
But I know from my own personal experience with my company, my accountant, when tax went digital and everything went digital, then I could have done that all myself. But actually, that's all handled, although I do the bookkeeping, because I don't have a huge number of invoices. I'm not a cleaning company or, somebody that's buying and selling lots of stuff. It's more service-based. Then I don't raise many invoices, so I can do my own bookkeeping. But all the digital side of it and all the submission that has to be done digitally now, that's handled by my accountant. Are you finding that's the way people are working with you now rather than doing it them all themselves?
The new changes has opened conversations up around that, and people are asking for help with it. It is something new, and people want to make sure they get it right.
Something you talked about, and I do want to talk about, is I think everybody's heard of sole trader partnership and limited companies, but I have variously worked for limited liability partnerships, LLPs. A lot of firms of accountants seem to be LLPs and solicitors. What is the difference between an LLP, because there's still liability in that term, versus a limited company, and why would you choose to go that route rather than a limited company?
So limited liability partnerships are a hybrid between a traditional partnership and a limited company. Now, what I mean by that is they carry characteristics of both. They have the flexibility of the partnership in how it operates, but they have the limited liability of the limited company. They're also registered at the company's house, but they're also a corporate body in their own right. So they are treated as a separate entity, which is how you get the limited liability protection, because they are not the same person as the individuals.
So in terms of liability, they have similar attributes.
Yes.
Why do I see more accountants, solicitors, firms of accountants, solicitors who they present themselves as a partnership? Why do they tend to go that route rather than the limited company?
So the partnership allows for flexibility in the traditional models within sort of professional services firms. You have various weird and wonderful profit sharing arrangements which can't easily be achieved at limited company level because of the share structure, whereas a partnership agreement has that flexibility. So that comes back to the internal constitution that I spoke about previously.
So I assume that relates to something that I've seen in those sorts of organisations where you'll have senior partners, junior partners, and people who just do the work.
Exactly.
And that's to do with how they move, how the different levels of remuneration, if I could even say it, within the company. There's more flexibility with an LLP to do those sorts of things as opposed to within a limited company.
Yes, so with a limited company, you have shares, so you pay dividends on those shares as part of your remuneration package. And if we had 50 shares each in our company, our hypothetical company, we would have to take out the same amounts, broadly speaking.
I see.
Whereas if we have a partnership, we can decide how we want to split those profits on a year-by-year basis.
But it's still registered with Companies
It is
House.
still registered with the Company's House, but the constitution document doesn't have to be.
So there's quite a lot of advantages to being an LLP if
There
you
is.
don't quite know how you're going to sort of share money out. So typically, again, I've worked for companies where I've been given options on shares and all the SCIS things
Yes.
and stuff like
Yep.
that. But the amounts that different people within the organisation have had is based on the number of shares that they've got.
Yes.
Whereas with an LLP, the sort of profits can be actually just distributed without any other layer of complication.
That's right. It is down to agreement between the parties.
I understand. That's I hadn't quite appreciated that was the case. It's very interesting. So,
Yes. Yes.
one other thing I really want to talk about, and I've got some quick fire questions in a minute.
Okay.
But before we get there, we've briefly talked about having a limited company and then forming a subsidiary company for different situations.
Yep.
Is that as simple as just creating a new limited company?
It can be sort of as straightforward as that. So you would have your existing company, you might have a different activity you want to try. So you would form a separate company to trial that out. It could be held wholly by that one company. The benefit is it can pay its profits up to that parent company, if you like, free from tax by way of a dividend, because dividends between the two companies are not taxable. So it's a good way that the holding company can set up the company, it can finance it, and it can get a reward. So it can get that reward and reinvest those proceeds in further subsidiaries if you've got future ideas that you would like to ring fence. So it's a good way to scale a business. The company at the top would not be affected by any risk of any claim against its subsidiaries.
So, in terms of what is the legal connection between a parent company and a subsidiary company? Is that just a Companies House thing?
It actually owns it. So if you imagine, take your company for instance, you own the shares in that company, so you are the owner. In this case, you would be the owner of your company, which in turn would be the owner of the subsidiary. So you wouldn't own it directly, but you'd own it through your own holding company.
Almost like an asset.
Exactly.
Okay. And with that subsidiary, can, say, for example, you've got your parent company has some product or service area that they potentially think they might want to protect or ring fence its IP, or maybe think that it's something that might be they could sell at some later stage. Can those assets be easily transferred across to the subsidiary company?
Yeah, so within a group structure, if you've got 100% subsidiary, you can transfer assets between the two without triggering any capital gains tax or any other tax charges which otherwise would arise if they weren't connected. So it is a good way to separate out assets between entities.
And also, I guess if you're thinking of starting some more risky venture where you're not 100% sure that something is going to succeed because it's a bit of a mad idea, whatever that might be, that's another way to ring fence activity and protect your sort of parent company from anything that goes on within that subsidiary.
That's right. So typically the parent company would hold all the capital, all the assets, and the subsidiary would carry on the trade. That trade may carry risks, but it means if anything happened to that company, the assets are held at a level which would not be subject to attack.
And I can see certainly for something like software, for example, if you've got an idea for a product, making a subsidiary company the owner of the IP of that product and run that product, whether it's a service or whether they're physical software or apps that you sell, if you think that that's something that's is something that could be sold to a larger organisation, it's not in the mix of everything else. Is that the case?
It is the case. So anything intrinsic to that business you could have in the subsidiary. if you were then to sell that as a business, as a complete unit to a big business that wanted to buy it, you would sell the shares in that subsidiary, which, if it's a trading business, carries various tax reliefs. Would most likely be exempt from any corporation tax on that gain.
That's fascinating, because I've got something potentially where I want to do that sort of thing. It's something that I know is a good idea, and it's been trialled and it's working, but it might be useful to push that into a subsidiary company, or, a legal way of ring fencing something to protect its risk, and potentially be something that's an asset that can be sold to somebody else without having any claim on anything that is owned by my main company.
Yeah, well, that would certainly be a sensible idea to separate it from your main activities, and have it allow it to grow in its own wrapper, if you like.
Phil, it's been absolutely fascinating. You've answered some of the general questions which I know people have got, but for me, you've answered some things that I've had on my mind about the confusion between LLPs and limited companies, and how subsidiary companies work with parent companies. So thanks very much for coming. It's been fascinating.
Well, thank you for having me. Cheers.
All good.